European listed REIT performance, fundamentals of listed REITs in Europe, and private real estate versus listed real estate in Europe. Welcome to the Real Estate Reel from Cohen & Steers. This month, you may have guessed it, we're watching Europe. First, European REIT performance has been challenged for nearly 2 years, with European REITs down negative 28% from their peak in August of 2021, driven by a combination of rising interest rates and slowing growth. By comparison, global REITs, which include US REITs, are down 16% from their peak at the end of 2021. These reflect significant declines, but they also include a rebound in global and European listed REITs. Global REITs were down more than 30%, and European REITs were down more than 45% at their lows in October. European listed REITs have then declined more than 31% in the last 2 months of 2023, compared to 25% for US listed REITs. In fact, November was the third best month ever for European listed REITs, as they rose almost 14%. And the strength continued in December, with the sector up 10.6% during the month. Net-net, full-year returns for global REITs were nearly 11% in 2023, with Europe at more than 17% at the end of the year. This rally is consistent with our view that the end of hiking cycles has historically delivered above-average returns, and that recessions have created attractive entry points for listed REITs, with the best returns historically occurring early in the cycle. This is playing out in real time now. In October, the ECB paused rate hikes for the first time in 15 months. While the European Central Bank has been more hawkish on future rate cuts than the US Federal Reserve, we think the US tends to be a leading indicator for international markets. Hence, European listed REITs responded to perceived pivot in the Fed's policy on interest rates. It's important to note that European REITs also have higher leverage than US peers, so they have more upside or higher beta market reaction to the turn to expected lower interest rates. Specifically, European listed REITs have loan-to-values of around 38%, compared to around 35% for the US. It's worth highlighting that both are relatively conservative compared to the private market loan-to-values. The second data point we're watching, valuations in European listed REITs. Despite the recent rally in European listed REITs, the sector still trades at a negative 13% discount to NAV compared to the historical average since the beginning of 2011 of negative 6%, ranging from a minimum of negative 34% to a maximum of 11%. Discounted valuations have historically marked favorable entry points, underscoring our view that there's likely to be normalization between listed and private valuations in Europe. What's happening is what historically happens. The public market forced listed REITs to sell, or not buy, properties when valuations were at the peak over the past several years. But we expect European REITs will trade at premiums to NAV in the coming years, thereby providing them more of an attractive cost of capital to acquire properties at discounted valuations. Indeed, we are already seeing this play out in other parts of the world, with global REITs trading at a 7% premium to NAV and the US at almost a 17%. Another measure of valuation is price to funds from operations, also known as FFO. Price to FFO currently stands at around 17% or so for continental Europe, compared to the historical average since 2011 of 18%, ranging from a minimum of 13 to a maximum of 23.3. In other words, European REITs are still cheap based upon their price to FFO. The third data point I'm watching is listed REIT performance versus private real estate in Europe. This is notable to watch because listed REITs are a leading indicator for the private market in both downturns and recoveries. Listed REITs typically lead private real estate by 12 to 18 months because they are liquid, daily traded securities that have real-time price discovery as a result. As you can see in this chart, while listed European REITs appear to have bottomed, the INREV index that tracks total returns of European private real estate funds that primarily own core commercial real estate has declined for 5 consecutive quarters and is now down negative 9.4% from its peak. We believe that the correction in private market valuations is only halfway through what we expect, but listed REITs have already priced this in. One final note on Europe. Our European investment team is expecting a stronger economic slowdown in Europe than in the US. As a result, they prefer somewhat more defensive sectors or sectors that have relatively high yield. This includes continental retail, German residential, tower companies, logistics with rental growth potential, and data centers, self-storage, and healthcare. The team is more cautious on more cyclical exposure and lower yields like prime office exposure or Swiss real estate as yields are low, and the same for rental growth outlook. Generally, our portfolio positioning is differentiated more by property sector and individual securities than by country, based upon common drivers impacting property types across the region. Subscribe to The Real Estate Reel via the link on the screen and tune in next month to see what we're watching next.